Hello, welcome to the European Open briefing for Tuesday, December the 6th. I'm Rafi Boyajian, currency analyst at XM.com, and we're going to be looking at the latest developments in the currency markets today. So we have a bit of a recovery in risk sentiment this morning. Yesterday there was some risk aversion following the no vote in the Italian referendum on changes to Italy's constitution, but markets were quick to shrug off the results as the way things are going at the moment, it's unlikely there will be fresh elections in Italy, and it looks like they will most likely appoint a caretaker government. So that's helped the markets recover quickly. The euro bounced back strongly to rise above the 1.07 level against the US dollar. In other currencies, though, the Australian dollar has come under pressure after the Reserve Bank of Australia gave rather a cautious outlook to the Australian economy. The US dollar is also softer this morning. Yesterday it did rise a little bit from strong ISM non-manufacturing data, but it's back down again today. And oil prices are also down on reports that major producers are increasing output to record levels. So let's begin with the euro. We can see that sharp turnaround in the single currency. Yesterday it dropped to 21 months low, and it rose sharply to a 3-week high, and this comes after markets were quick to shrug off any fears from what the no vote in Italy's referendum may mean for the Eurozone. At the moment, it's looking like the current Prime Minister Matteo Renzi will stay on over the next few days, maybe a bit longer, until the new budget is approved, and then a caretaker government will be appointed. The main fear was that if the no vote led to fresh election, then it might allow anti-establishment parties to gain power, and that would have been negative both for Italy and the Eurozone. So the next focus for the Euro is Thursday's ECB meeting. The ECB is expected to extend its QE program by another 6 months, but markets, analysts are going to be scrutinizing what Mario Draghi will be saying, as he may hint that the ECB may begin to cut down on the asset purchases after the next 6 months are expire. So that's next on the watch list for the euro. Let's move on to the Australian dollar now, because the Reserve Bank of Australia had its policy meeting today. They kept rates at 1.5%, as was widely expected by the markets, although it did surprise analysts by saying that growth will be weaker towards the end of the year. So this does once again keep the option open that rates may come down further in Australia, because up until now the RBA had maintained a neutral outlook, and it was looking increasingly unlikely that there will be further cuts, but now it's saying that it's keeping that option open from today's statement, and this was supported by weak export data, net export data, which showed that in the third quarter net exports had a negative contribution to GDP. GDP data is due later this week, and if that shows a weaker than expected number, then the AUD will probably come under further pressure. Let's have a look at the US dollar. Here we've got the chart. We have the dollar index. We can see that it has been declining over the past day or so. This is because basically investors are seeing that the current rally is slightly overdone, although yesterday's strong non-manufacturing PMI, the ISM non-manufacturing PMI, is giving some support to the greenback. We had several Fed speakers speaking yesterday, including Dudley Evans and James Bullard, all of them which reinforced expectations that the Fed is likely to raise rates in December, and this has pushed up the odds of rate hike as implied by the futures market at 95%. Let's have another look at the pound, because the pound is it's doing rather well at the moment. It's being supported by, on the one hand, in the negative developments regarding the Eurozone is giving the Brexit woes for the UK a bit of a respite, but also, of course, last week's statement by the Brexit minister in the UK, who suggested that the UK is open to making financial contributions to the EU to retain access to the single market. Other developments for the UK at the moment is that the Supreme Court has begun hearing the government's argument on why it should overturn the High Court ruling that Parliament must approve the triggering of Article 50. There hasn't been too much of a reaction by the markets, and it's hard to say how markets would react whichever way the Supreme Court rules, because what markets want to hear is just more detail, more information on what Brexit will look like. But at the moment, the pound is being supported by what's happening with the euro on the one hand, and also just on hopes that we won't see a hard Brexit. So at the moment, the pound is currently trading at 2 months highs versus the US dollar. Let's move on to commodities now, because gold yesterday touched a 10-month low. This came after a bit of a spike upwards from the Italian election referendum results. The risk aversion only lasted very briefly, and then demand for safe havens quickly fell back, and that pushed gold down to a 10-month low. Crude oil, on the other hand, yesterday rose to a 17-month high. There does seem to be signs that non-OPEC countries such as Russia will likely join in cutting output. Although today oil prices have come back down a little bit because of signs that most major producers are in fact increasing output ahead of the planned cuts. So all the major producers are basically beefing up production before they start cutting back. So that would likely lessen the impact of the planned cut, because basically the oil market is going to be even further oversupplied even before the cuts begin to take effect. Let's move on to today's calendar. We can see that early in the day we had the Australian data. The current account deficit was the deficit was much smaller than expected. But the main focus was the net exports contribution to GDP in the third quarter, as it was expected to be neutral, but in fact came in at minus 0.2%. So that will likely mean weaker than expected growth in the third quarter in the GDP data that's due later in the week. The cash rate, the RBA's cash rate, was kept at 1.5%. We did have some positive industrial orders data out of Germany that came in at 4.9% versus expectations of 0.6%. And coming up later, we have another estimate of GDP data in the Eurozone is expected to be confirmed at 0.3%. Later on, we've got a dairy auction which is likely to impact the New Zealand dollar. And then in the US, it's a quieter day today for the US calendar. The main data will be the factory orders. And then out of Canada, we're going to see some trade data and the IV PMI. That's it from me. Thank you very much for watching and have a great day.